Alright, this video is going to be on revenge trading and letting your trades run. One of my viewers had left a comment on one of my videos explaining how these two things were some things that he was struggling with, and I thought that was a great opportunity to make a video on it because I'm sure there are other traders in the same boat and there's value to gain for everyone. So let's jump right into it, okay? So, revenge trading. In my experience, revenge trading was always a result of these three factors. The first one is you struggle dealing with uncertainty. Now, by default, us humans naturally struggle with uncertainty. We want reason, we want things to make sense. I'm sure you understand that as a living being, right? Now, when you begin to trade and you begin to develop strategies, you realize that you're not going to win every trade, right? You're going to go through losing streaks. You are uncertain whether the next trade is going to work or not. And in order to be a successful trader, you have to be willing to accept that. You truly are not sure whether the next trade you take will be a winner or a loser. And that's a natural thing as a trader. That's totally normal. The other part to that is your own ability to execute trades. Perhaps you are uncertain to what you are doing, right? Perhaps you read a strategy online, or you are suggested a strategy and it may make sense to you when you read it, but then when you go to the chart and then you see price start to move, you start to wonder, how is this strategy going to perform in the future? And that uncertainty will start to leak into your decision making. It'll start to leak into your confidence. Now, not only are you dealing with the uncertainty of the way the market is going to, correlate with your strategy, you are now also uncertain in your own ability to make money as a trader. Those are two completely separate states of mind, by the way. If you are confident as a trader, you develop the skill to make money trading. You no longer are uncertain in your ability to make money. And as a byproduct, you are okay with the uncertainty of whether the next trade is going to be a winner or a loser. You're okay with the uncertainty of when the losing streak will happen, because you already have certainty in your ability to trade. So how do you overcome that? You need to spend lots of time trading your strategy, refining your strategy, back testing your strategy, forward testing your strategy. You need to understand your strategy to a T. You need to the point where you're completely calibrated to take those trades. When you see your strategy form, you don't second guess. You don't execute differently than you did the last time. You execute it the same every single time. Again, that's built through repetition. You have to be deliberate and show up every single day and execute it the same way every time. Again, if you're confident, it will not be an issue to do that. But when you're in learning phases and you're still testing things out, you're still getting your feet wet. So it's very important to get in there and collect data, get a massive sample size over, stretches of years, right? Because you can go to the chart, press bar replay, and backtest the past 5 years, and see how your strategy would perform. It might take you a couple days or so, but that information is important because now you have some sort of confidence behind what you're doing, and it helps with your pattern recognition. The more that you execute that strategy over time, when you see it live, you know exactly how you need to execute it. So that is how you get over the uncertainty with yourself. The uncertainty with the results of your trades is always going to be there. Your biggest issue is going to be not only dealing with that kind of uncertainty, but also dealing with your own uncertainty as a trader. You're compounding it, and it's a terrible mind state to be in. That is a very sneaky way where now that revenge trading mindset creeps in, because subconsciously what happens is if you aren't confident enough in your ability, once you start taking a loss or two or three, now you start to doubt yourself. Now you start to doubt your career as a trader. And then you say, you know what? I'm just going to make it all back on this one trade because I'm unsure that I can do it over the long run. And that's when you blow it up. Something to consider there. That's probably something that you never heard before, but I guarantee you that is one of the biggest reasons why, and it's because it's kind of trapped in your subconscious mind. Okay, so let's move on to the next one. Lack of structure in your decision making. And this is where your discipline is tested. Now, what does this mean? Eventually, you're going to get to a point where you have a strategy, right? And your strategy is going to have rules, right? And how your relationship between, or maybe not relationship is the best word, but the way that your mind thinks about your strategy is very important. Okay, so what do I mean? When you look at the market and price starts to move, and you start thinking of ways to trade, what's going to your mind? Are you automatically thinking of the money? Is your mind jumping ahead? Are you starting to get distracted with other things? Are you starting to, maybe you look at the chart for a second and then you look at your phone, or maybe you're trading from your phone. Maybe you are trading and you sort of have something else that you need to worry on. You're talking to somebody on the phone, or maybe you're at the store or something and you're not in front of your trading setup. This is what I mean by lack of structure in your decision making, right? Because you decided to plan trades while you are running errands or something. That's terrible. You need to dedicate time to trade. When it comes time to trade, you unplug everything. You turn off the TV, you keep your phone from a distance, and you focus on the task at hand. I like to listen to music when I trade. Perhaps that's something that you find is helpful for you. I find that it's keeps me in the zone, if you will. And so, lack in your decision making, perhaps you have a rule that says, I'm going to trade from 9 a.m. to 12 p.m. every single day. Okay? But say the one day or the night before you had one too many and you wake up at 12 p.m. Well, and then you decide to go to the markets. You already broke your first rule. You didn't wake up at 9 like you did the rest of the days. On this day, you woke up late and then you decided to start trading. That was your first mistake. Things like that, right? It's little things like that. And eventually you'll realize when you break a rule, you'll catch it, right? Journaling is also very important because journaling is where you catch your mistakes. You don't understand how many mistakes you are making until you start journaling. Once you start journaling, then you look back and say, "Wow, I really am making a lot of mistakes." Because us naturally we're biased and we think we know more than we actually do. So once you actually start to document your own behavior, you start to realize, okay, I need to make changes. And that's why I mean lack of structure in your decision making, because over time you realize that the decisions you make are ultimately either benefiting you or detrimental to your trading. And eventually you will begin to create structure around not only your strategy, right? Of course, you need to execute your strategy to the T, right? But you also need to have structure in how you go about making decisions. And another thing is, without rules, there's no discipline. So if you have rules but you don't follow them, obviously that's breaking discipline. And if you don't have enough rules, or maybe you have one or two rules, or whatever the case is, well, that's not really putting your discipline to the test. And I'm not saying to make everything complicated and have a 10 rules, but if you struggle with discipline, maybe you need 10 rules. You know what I mean? It's something to consider. Okay, the next one and the last one, this is like the obvious one. It's the one that you know you shouldn't do. It's one of those habits where it's like you look back and you say, well, what happened? Well, I sized up and you lost it. And of course, it is you are trading with too much size. And this is always going to be an emotional decision, because it could be two things, right? You can have so much confidence in one particular setup. I know it's going to go up. I know it's going to hit my target. And it doesn't. And then you take a bigger loss than you should have. Where did that emotion stem from? It stemmed from your bias. It stemmed from your own emotion, if you will. You felt like this was going to be the home run. And eventually you realize that that's not a great strategy over time. You realize that it's much more consistent. Say you have a rule that says I only risk maximum 2% of my bank or of my trading account. You never go over that. You know that if you go over that, you broke your rule, you broke your decision, and somewhere in between the lines, you lack structure in your decision making. So you always stick to those rules. And of course, if you take, let's say you take 4 losses in a row, and on the 5th trade, you say, I'm risking 5% so I can make my money back and then a profit on top of that. Well, that's gonna, what happens if you lose that trade? Now you're down 9%. And now you feel like even more SHIT, because you knew that that could have been prevented. It didn't need to get to that point. So these are things to consider. Again, I have a very structured way of I go about my trading. And maybe it's a little overboard. Maybe it's a little too much. And sometimes I even wonder, I don't need to be this structured. I can tone it down. I could remove some parts, because sometimes it's just it's for my own safety sometimes, because I was once struggling with these issues, right? So my complete structure and rule set, there's a lot to it, because, and like I said, it's for my own safety, and I know that if I'm following my rules, that whether I take a loss on the trade, it's not going to affect me whatsoever, because I know that it was just a natural loss due to variance. Compared to if I broke part of my rules and then lost the trade, well, now you feel like crap because you knew that that loss could have been avoided. Way two different feelings. It's night and day. You can live with the uncertainty of your next trade turning out to be a loser, but it's much harder to deal with your own emotions when you let your emotions get in the way and then you take that trade because you know that it shouldn't have happened. Okay, now we're going to get to more of the trading stuff. Well, not that that's trading, but we're going to get to more of the price action, more of the, we'll get to some charts. And the next topic is trade management and the difference between letting your profits run versus using a fixed target. Now, there will be a lot of debates to this, I'm sure. I'm sure that people will say, I have an algorithm that trades automatically and times tops and bottoms perfectly and so forth. Okay, that's great, right? But I'm not a bot, okay? So I'll tell you what works for me. I'll tell you what I have tested. And listen, if you don't believe what I have to say, that's great. Go ahead and test it and see for yourself. So when you let your profits run, right? Say you enter long and the market is trending up. Or perhaps you buy a breakout and then the market continues to rally to the upside. And you say, I'm going to let my profits run on this one. Versus using a fixed RR or a fixed maybe swing high, for example. When you let your profits run to see how much further it will go in your favor, you will always give some of it back because when you see the profits going up, it's going up. You have no reason to exit, right? You see, oh, bull bar, another bull bar, great. Next bar, another bull bar, great. Next bar, another bull bar, great. At some point, there's going to be a bear bar. What are you going to do then? Now you just gave back some of your profits because the last bar had a high at one point, and now the next bar is starting to trade lower. You already gave back. You're already now in drawdown from that high, right? And then what do? Do you? Because now it's tricky. The question is this just a pullback? Is it going to keep going higher? Is this going to go sideways? And that's the risk that you expose yourself to find out how much reward you're actually going to get. So the main idea there is that by letting your trade run, you're exposing yourself to risk to find out how much more reward you'll get. And you will always give back some of your profits in that case, because you're trying to find out how much more it will go. Eventually, it's not going to go much more. Eventually, it's going to stop. And now the question is, where do you get out? Sometimes you get out sometimes you get a 5-to-1 trade. Sometimes one bear bar can give back half of your profits. And now you're looking back like, oh, great, well, that trade could have been a massive winner, but instead, now I'm here with back to break even, That's the risk that you run to find out how much further it'll go in your favor. Now the next point here. In many cases, taking profits at a fixed risk to reward or a specific price will outperform staying in the trade to see how far it will go in your favor. So when you use a fixed risk to reward, or perhaps a swing high or a swing low as your exit, you're exiting at a price where it's the top, right? You're capping your ceiling. Because what happens if price wicks through a swing high and then immediately reverses, but you say, well, I'm going to see if it breaks out and continues higher? Well, now you're giving back profits compared to if you just placed a limit order at the top of a swing high, and once it trades through it, you got the best exit, you got the best price, you got the most profit out of that move, compared to speculating on whether it's going to be a breakout or potentially come back to your entry. That's why I say that this will outperform letting your profits run. Now, the last point, which is the most important. In order for this to work, you need a positive expectancy. Now, what does that mean? This is a statistical term to basically show you or tell you, explain to you that you have an edge over a long period of time. Right? So if you go to a casino and you play blackjack, the dealer is going to take all of your money in the long run. They have a positive expectancy because they have a better chance of winning the hand than you do. And every time you place a bet, you only make what you bet. Right? When you play a blackjack hand and you bet $10, you only make $10 profit. You don't make 30, you don't make 40, you don't make 50. If that was the case, if you bet $10 and you made 50 every time you won, well, now you have the edge, right? Because in blackjack, the dealer has about a 52% chance of winning, and you have about a 48% chance to win. However, each bet you place is 1-to-1, meaning in order to break even, you need a coin flip. But in this game, you're losing 48% of the time. It's not 50-50. The chances are slightly against you. So as long as you continue to play that game in the long run, you will continue to lose money. So in trading, in order to have a profit with a fixed risk to reward system, you need a positive expectancy. So let's go to the charts and kind of go over all of these trade management points that I made. And I'm just going to bring up a random chart. I prefer to do a 5-minute just so we can get a lot of volatile swings. And here we have Apple. It's just completely random, right? Now, let's just assume for a second that it's almost not an assumption either. You can go ahead and backtest this as well. But when you see this sideways price action right here, you see it's a trading range, right? Then you get a bull breakout. Your odds right here of getting a 1-to-1 is about a 60% chance. That's an edge. That's positive expectancy, right? So you can see we get a 1-to-1 after you get this big breakout. You place your stop loss at the low, you get a 1-to-1, right? That's an edge. That's positive expectancy, right? Because if you're risking 1 to make 1, if you break even with a 50% chance, and you don't even really need to know statistics or probability to make an assumption. When you see a big bull breakout, who do you think has the advantage, the bulls or the bears? So when I say high probability, I'm not saying you have 85.7632 chance of winning this trade. No, when I say high probability, all I mean is you have a better than 50% chance. You don't need perfect math, you just need good math. I learned that one from Al Brooks, right? You don't need to know exactly the perfect probability formula, whatever. Just know that a high probability is better than 50%. Low probability would be less than 50%. And if you have a low probability trade, perhaps that's a counter trend trade, you need to go for 2-to-1. And what I've found, what I've tested rigorously, night and day, many years, is when price is above the 20 EMA, you can assume that your chances of winning are better than 50%. So when price is above the 20 EMA, I go for 1-to-1 because in most cases, I understand that my chance of winning is better than 50%. If the price is below the 20 EMA and I want to go long, I'm trying to get a 2-to-1 because I know that my probability is probably less than 50%. And there's other things that go into probability, like your ability to read price, the context of the market. These are all very important. And if you want a better edge, right, a better chance of winning, you have to combine all of these things. You need to combine the higher time frame. You need to combine the context of the trade you're taking. And then when you get to your entries, right, then you can look at the EMA and say, well, look at this. We really broke up above this EMA. What do you think your chances are? I would say high probability, better than 50%. So I would just go for a 1-to-1 here, right? And let's say you decide that I'm not going to do a 1-to-1. I'm going to see how far this sucker runs until when, right? And you have to determine your exit. You have to have your own system. You have to come up with some sort of reason or some sort of exit plan. So do you say, oh, I exit when the bull trend stops? Okay, well, it stopped right here. In that case, you would have got definitely more than 1-to-1. You would have got 1.3. Not bad, right? You outperformed that trade, right? Now let's use a different example. I just kind of want to randomize it too, because I want to show you exactly what I'm talking about. I don't really want to know what's going to happen next. Let's do bar replay. Just trying to just completely randomize. Scroll back some. Okay, let's just start here. Let's find a breakout, right? Let's find a breakout. So we have a sideways market. No, that was sort of a breakout, honestly, right there. What you took at this trade, I don't know. It's tough because we're not using higher time frame at this point, but let's see if we got another breakout here. Let me try to go slowly so we catch it. This is a trading range for sure. Still a trading range, right? This is I want it to be very obvious. Okay, right there. Okay, say we enter short on this one. Let's just put our stop loss right here. And we're going to do 1-to-1 and see if we get it. But let's say we don't exit at the 1-to-1. Let's say we wait for, let's say we wait for the trend to reverse and see if we get better than 1-to-1. Okay, so let's go for it. Perhaps we don't even win this trade either. And what's funny is we kind of already broke the trend right here. Right, so at this point, look, the way I would be looking at this trade is we're broke below this. We had a breakout, then we formed a channel, right? Now we're breaking above the channel. Now what I'm going to be assessing is how aggressive the bulls get. Right here, this isn't a very great breakout, right? So let's see. What is the next? I don't like the way this bar closed. Okay, we got another move down. That's good for the bears, good for our trade. Now this is sort of a trading range forming now, right? Okay, I don't like that bar for us, trading range. Okay, we get a breakout. At this point, I would trail my stop to there. And we still are trying to aim for that 1-to-1. Okay, did we get it? And now this trend is evolved into sort of something like this. We don't know yet. We don't know if that higher low is going to work. This is just kind of a speculating here. Okay, we would have got a 1-to-1. And we would have won that trade, right? If we stuck with 1-to-1. But let's see if we get more downside. Okay, we're trading beyond it. That's pretty good. And let's say we exit above that trend line. Okay, tested the trend line. I wouldn't say that's a great break. Okay, well, at that point, I would have definitely exited, maybe even right here, maybe even right here. And you roughly get about the same, right? You roughly get a 1-to-1 again. Except when you exit right here, you have no more risk on the table. When you stay in the trade, you risk giving back profits, right? Unless you have some sort of ability to time this as the bottom, I don't know how you're going to be able to manage a trade. If you see it go back to the trend line, it's reasonable to assume that it keeps going lower, right? So how would you manage it? Would you manage it when the price finally breaks above it, breaks out of it, breaks against it? Perhaps you exit somewhere around here. Okay, but it's still in that 1-to-1 ballpark. All right, so let's keep going and just see what we find here. At this point, this is looking like a bull trend. All right. It's no longer have trading range type tendencies. It's not a very strong bull trend. But let's see, we want to buy a pullback. There's a breakout. It's not a very strong one. Whoa. Okay. They got a breakout. The bulls got a breakout, but the bears immediately shot it right back down. So maybe this is a reversal. Maybe if we get another bear breakout here, perhaps below this line, maybe we enter short again. We have a trading range forming right here. And so what I'm going to do is draw this so it's quite obvious. You have support, resistance. And we want to see a breakout. Okay, there we go. I don't like that next candle, to be quite honest with you. And now what this looks like is a more broad bull trend. You have that little overshoot right here. This is kind of interesting. Okay, we're gonna disregard that trade because I don't. Yeah, it's like a bull trend there. Okay, and now it's still sort of a trading range. Okay, we break out below that trend line. Not great breakout. I want to see a very aggressive breakout or maybe even a bear trend form. Trading range. Okay, failed breakout. Still a trading range. Okay, at this point, I would consider that a bull breakout. It was nasty. You had a trend, trading range, and a breakout. This one's tricky, honestly. But we're going to go for the 1-to-1. And maybe I put my stop there. Maybe I don't let it run all the way down. Get a 1-to-1. Let's see. Okay, we easily get the 1-to-1. But we don't exit, right? Now we're waiting for a reason to exit. And now we see a very tight trend like this. Perhaps we exit when that trend line breaks. Okay, we're still in the trade. Let me adjust that. Okay. Now it broke below that trend line. I don't know. I did say we would exit below the trend line, But now you have to wrestle with the idea that this could be a trading range and then you get a breakout higher, or maybe we test the EMA and get a breakout higher. That's the risk you run when trying to find out how high it's going to go. So let's just see what happens here. Let's say we stay in because we anticipate a bounce off the EMA. And we get a trading range. Okay, in this case, we got rewarded. Now you're definitely seeing, this is still sort of a trading range up there. Trading range. Now you're in a trading range, right? So now it's like, okay, now we're in this sideways market. Maybe now we get the breakout to the upside, right? Now maybe it goes higher. Oh, in that case, you would have really got rewarded. But what was your plan? Was your plan to exit below this low? Or, I'm sorry, below this trading range? Well, you would have exited right there and gave back all this profits compared to if you exited at 1-to-1. Even, let's say we decide to stay in this trade. We didn't exit below this swing low. Okay, let's say we decide to stay in it. Well, we risked the entire profits to get back to break even. But in this case, we did get rewarded. We did get that breakout. And that, if you would have stayed in it, you would have gotten rewarded there. But it all comes down to how are you going to manage it. Going back to what I said here, in order for a fixed target to work, you need a positive expectancy, right? So I know as long as I'm trading my plan, I'm trading with the market context, I'm trading with the higher time frame, and then I see a big bull breakout above, the 20 EMA, I know that my chances are better than 50%. I know I have high probability. So all I need is a 1-to-1 to have a positive expectancy. Again, using the blackjack analogy, I may have a 55% chance of winning while the sellers have a 45% chance of winning. Well, now I can play that game. I can play the 1-to-1 game, the blackjack game. I risk 10, I make 10. And I will continue to print money as long as I'm doing that. When you start to have these variations, or I guess these variable risk to rewards, you're testing to see how high it can go. You don't know where your expectancy is, because each time it's going to be different. Maybe perhaps over 1,000 trades you find an average, but on the next trade you are unsure of what your expectancy is going to be. Maybe it trades beyond and you get 3-to-1, 2-to-1. Maybe it trades below and you end up giving back some profits or breaking even, when you could have just got the 1-to-1 where you had the edge and collected your profit and continue repeating that over the long run. What's the alternative? You speculate to see what your expectancy is going to be. You take the gamble. You keep the risk on the table to find out if you'll make more. Yeah, I'd rather just take my chances when I got in the trade and stick with that. It's tricky. You have to test these things. You have to see it for yourself. I've done testing on it, and maybe I'm just not skilled enough. Maybe when I'm in a trade and I start giving back the profits, I get stubborn and I say, you know what? I'm going to stay in it to see if I could get the profits back or whatever, Perhaps you have some sort of rule set that you develop that say, okay, I'm going to wait until the trend line breaks and then you exit. And then, okay, if you waited on that one on this one, if you waited for the trend line break on this one, you would have gotten less than a 1-to-1. Right? What's the trend line break? Is it this one? Maybe. Is it this one? More, yeah, at this point it's definitely certain that this is no longer trending, right? It's definitely sideways. So if you would have exited below that bar, you would have gotten less than a 1-to-1. But again, you have to test and see what, maybe you say, okay, I don't exit until you start putting in lower highs and lower lows. Well, right here, you put in lower highs and lower lows, and you would have really underperformed that 1-to-1, right? At this point, this candle, it's pretty obvious that you're putting in lower highs and lower lows. You put in that lower low right here. You would have definitely underperformed that 1-to-1. Anyways, I know that this one is a little more. It's introducing some statistics. It's also talking about a topic that isn't really the most popular topic, which is the psychology side. Everyone wants to know how to read the chart, how to read the bars, and rightfully so, right? Because that's where you're making the money. But I do hope that this one helps anyone that is going through these kinds of struggles, or maybe going through these phases of testing to find out their expectancy. They're trying to find their edge. Anyways, that'll wrap it up on this one, and I'll see you guys on the next one.